Hello everyone, welcome back to another video. My name's Sam and today we will be embarking on an exciting journey into the world of finance. The topic in hand is equity indices. We will unravel the complexities and shed some light on the mechanisms that drive the global markets. But before we do dive in, we want to hear from you. Drop your questions or share your thoughts on indices in the comment section down below. And remember, stick around till the end of the video for some very valuable insights that you don't want to miss. Let's begin. Equity indices, also known as stock market indices or simply indices, are statistical measures used to track the performance of a specific grouping of stocks or equities in a financial market. Here, let me provide you with a visual example. The S&P 500 index, for instance, tracks the performance of 500 large-cap American companies such as Apple, Tesla, Alphabet, Microsoft, and so on. It represents about 80% of the total US equities market value. A similar index is the FTSE 100, which tracks the performance of the top 100 companies in the UK, and the Nikkei 225, which tracks the performance of the top 225 companies in Japan. These indices serve as a benchmark for evaluating the overall performance of the market or a particular sector within it. They provide investors and analysts with insights into the general direction of the market, trends, and relative performance of different segments of the economy. But what determines which stocks enter or exit their corresponding index? Well, the individual stocks within the equity indices are chosen based on certain criteria, such as market capitalization, sector classification, geographic location, and other factors. These stocks represent a cross-section of the market or a specific segment of it. For example, the S&P 500 index that we mentioned earlier includes 500 large-cap US stocks, while the Nasdaq Composite Index includes mainly technology and growth-oriented stocks listed on the Nasdaq exchange. Now, since we've established the basics of what an index is, let's take a closer look at some of the most popular and talked about examples in the United States. There are three popular indices. The S&P 500, which represents the performance of 500 large-cap American stocks. The index includes companies from various sectors such as technology, finance, healthcare, consumer goods, and industrials. Companies such as Johnson & Johnson, Apple, and Microsoft. The Nasdaq Composite, which consists of over 2,500 stocks listed on the Nasdaq exchange. It's heavily weighted towards technology companies, but also includes stocks from other sectors like healthcare, consumer services, and industrials. Good examples are Facebook, Amazon, and Tesla. And then of course we have the Dow Jones Industrial Average, which comprises 30 large-cap blue-chip stocks listed in the New York Stock Exchange and Nasdaq. It represents a diverse range of industries, including technology, finance, healthcare, consumer goods, and industrials. Well-known companies include Walt Disney, Boeing, and Visa. Moving away from the United States to some more international indices, we have the United Kingdom's FTSE 100, which trades the performance of the 100 largest companies listed on the London Stock Exchange by market capitalization. This includes companies from sectors such as finance, energy, mining, healthcare, and consumer goods. Examples are BP, GlaxoSmithKline, and Unilever. Germany's DAX, which represents the performance of the 30 largest and most actively traded companies listed on the Frankfurt Stock Exchange. Constituents are primarily from sectors such as manufacturing, automotive, finance, technology, and healthcare. Companies like Siemens, Volkswagen, and SAP. And of course, Japan's Nikkei 225, which includes 225 large-cap companies listed on the Tokyo Stock Exchange. It represents a wide range of industries, including technology, automotive, finance, healthcare, and consumer goods. Some big examples are Toyota, Sony, and Nintendo. All these equity indices are dynamic, constantly fluctuating in response to various factors. Some of those factors are economic indicators, such as the GDP growth, inflation rates, and employment numbers. The earning reports of individual companies within the index market. Sentiment changes in interest rates set by central banks, and of course, corporate actions such as mergers and acquisitions, stock splits, dividends, and share buybacks. Understanding these factors is essential for making informed investment decisions. And if that's something you'd like to do, then investing in equity indices can be done in several ways. One common method is through index funds or exchange-traded funds, otherwise known as ETFs. Investing in an index fund or ETF, you gain exposure to a diversified portfolio of stocks that make up the index. Direct stock investment is also an option, of course, which requires you to buy individual stocks that comprise the index. This approach, however, requires more research and may result in less diversification. Index CFDs is also a very popular method of trading equity indices. CFDs are derivative products that allow investors to speculate on the price movement of equity indices without owning the underlying assets. With CFDs, traders can buy or sell an index, potentially profiting from both rising and falling markets. However, this also means that traders can potentially lose from either direction as well. All investment methods are viable in their own way. However, it is essential to consider your investment goals, risk tolerance, and time horizon when trading or investing in equity indices. Additionally, staying informed about market developments and conducting thorough analysis can help make informed decisions and manage risk effectively. And with that being said, let's summarize what we've learned today. Equity indices are baskets of some of the best performing companies in their respective region. Each index has its unique characteristics, reflecting the economic landscape and investor sentiment of its region. Equity indices are dynamic, constantly fluctuating in response to various factors. Futures and options, index funds and EFTs, and index CFDs are all different options that a trader can choose to invest in indices. Staying informed about market development and conducting thorough analysis can help you manage your risk more effectively. And that should cover all the basic details about equity indices. Let us know if you'd like to see a more advanced version of this topic in the comments section down below. We've also launched our brand new official FXGT.com blog site, which you can visit to read up on anything related to the markets in as much detail as you'd like. We have multiple different topics that are tailor-made for all kinds of traders and enthusiasts. You can visit fxgt.com/blog or simply click the link in the description. Don't forget to like the video and subscribe to our channel. And since you made it this far, here are 2 more videos that you might like. I'll see you next time.